I'm Mark Riepe. I head up the Schwab Center for Financial Research, and this is Financial Decoder, an original podcast from Charles Schwab. It's a show about financial decision-making and the cognitive and emotional biases that can cloud our judgment. Welcome to part 2 of What Makes a Financial Plan Fit Your Life. If you missed part 1, it was season 20, episode 7, and we'll link to it in the show notes. We looked at the planning process for big financial decisions. In part 2, we're going to look at some of the connections between your portfolio and your plan, and we'll look at what the purpose of a portfolio is, along with how to manage your portfolio and some other things that can affect your portfolio and your plan. Steph Shadel is back to help us tease out the answers, but before we hear how she helps clients with those questions, let's look at portfolios in general. It's been said that a portfolio is the embodiment of a plan through time. Without a plan, a portfolio has no guiding principles. It's really just a collection of random investments. When you build a portfolio that follows a plan, and that plan is designed to help you with a goal, it becomes a powerful tool. A tool that can help you achieve pretty much all the highest priority financial goals that people have. College tuition, your kid's wedding, a dream vacation, a secure retirement. The bottom line is, your plan for your financial life is what drives your portfolio. My guest knows this better than anyone. Steph Shadel is a director and senior wealth advisor at Schwab Wealth Advisory and has been helping Schwab investors for more than 15 years. She's a chartered financial analyst, a certified financial planner, a certified private wealth advisor, and a certified wealth strategist. Steph Shadel, welcome back to the show.
Hey, Mark. Happy to be here.
So last episode, we went through some of the steps of making a financial plan, and we unpacked a lot of the key decisions that planning requires. So for this episode, though, I want to dig into what comes next, and that is really executing the plan through the process of portfolio management. And let's start with maybe just that term portfolio. It's such a big, broad term. Before we dive in, define for listeners, or at least provide listeners, your high-level take on what we should or perhaps shouldn't perceive our portfolios as doing.
Well, I think it's important to be aware that how you perceive your portfolio affects how you manage it. It's just as much about math as it is about behavior. And as you said, the portfolio is how we implement your financial plan. The plan outlines what we need and want, and the portfolio is how we do it. It's a mix of investments to help you reach your goals. It's a reflection of your financial objectives, as well as your ability and willingness to take risk. It also incorporates your personality, your preferences. The right portfolio is one that you can stick with in good and bad markets because it takes effort and time to build wealth.
And that process is going to take some risk, as you just mentioned. So I want to drill down on that point. How do you help clients understand the importance of risk tolerance when deciding on what their investment strategy is going to be?
For a lot of folks, risk tolerance is an abstract idea. So I redefine what risk means. It's not just about losing money. It's volatility. It's uncertainty. Risk tolerance refers to trade-offs. But your risk tolerance is a major factor in determining the proper investment strategy or allocation. There's also the difference between someone's ability to take risk or capacity to take chances versus their willingness to take that risk. I could have a young client in their 20s with plenty of time ahead of them and the ability to take risk, but they may not want to because it makes them uncomfortable. So I try to take time to understand their concerns and provide education because I really want to help overcome that lack of willingness to take risk. On the other end of the spectrum, a senior client may want to take on more risk because they enjoy it, but their cash needs rely heavily on the portfolio, which really reduces their ability to take on a lot of risk.
So tell me a little bit more about some of the tools and techniques you use to help facilitate that conversation.
So whenever we're creating model portfolios, I translate those percentages, the risk and return figures, into dollar values, because putting it into dollar terms can make it more real and get clients to think about their comfort level with risk. So for example, a conservative portfolio with less equity, more bonds and cash, well, that lost a lot less money than a moderate portfolio with more equity during the financial crisis. And that moderate portfolio lost less than an aggressive portfolio that had even more equity during the financial crisis. So asking the client how they feel about that, which loss is more acceptable? If that happened again, would you be able to stick with it, or would you be tempted to sell out? And that's really what I'm trying to get at. Because selling out that can really derail your plan and the portfolio. And also understanding how they've reacted in the past, during the dot-com bubble bust, the financial crisis, and just kind of understanding, again, what that experience was like, what their emotions were like, and what they ultimately did. But at the same time, the client could be in a completely different situation than the late 90s or during the financial crisis. They could be retired now. So it's different frame of mind. But we could also look at, someone that is just starting out, just got their first 401k. So they haven't experienced any major volatility yet. They may not have been born when the dot-com bubble burst. And while we've gotten used to shorter recoveries lately, the bad bear market can take time, years even. You have to ask yourself how you'd handle losses over a couple of years. So determining the risk tolerance can take time for those that haven't invested much before or are in a completely different situation from when they first started investing. And it can change when life changes. So it's important to do a pulse check every now and then and confirm you're taking on the right amount of risk.
Steph, a couple buzzwords come up again and again with portfolios, and one is diversification, another one is rebalancing. Maybe let's start with the easier one of those, and that is diversification. Talk to me a little bit about that.
Well, diversification is meant to spread the risk of different asset classes across the portfolio while maximizing returns. But it doesn't avoid risk or taking on a calculated or acceptable level of risk. And so the goal is to reduce specific risk, but not market risk. We just have to accept that.
And that specific risk is the risk of a single asset class or a single security or a single manager, that sort of thing, right?
Exactly.
Then rebalancing, a little bit more complicated. How does that help investors when they're deciding if adjustments are needed and what those adjustments should be?
So over time, a portfolio will start to drift or move away from your target allocation. And again, that target allocation is a reflection of your objectives, your preferences, and your risk tolerance, your financial situation. And that's not necessarily a bad thing as long as you're monitoring it. But after a couple years of strong stock returns, for instance, your portfolio may have too much stock exposure. And the concern is, if we do see a sell-off or a pullback or what have you, you could be caught off guard, and all of a sudden you're seeing a lot bigger losses than you were expecting. And that's because now you have too much stock exposure. So rebalancing addresses this by buying and selling investments when the portfolio falls outside of that target range. And so it's a good idea to set that acceptable degree of drift, or what's that range you're comfortable with? Is it a 5% imbalance where you have 5% over a said target or under? Is it 7% or is it 10%? So once you've selected that trigger to rebalance, stick with it, remain disciplined, because you're going to do the same thing on the other side of the equation. If there's a dramatic sell-off and now you've got too little equity, it might be time to buy. So rebalancing tries to keep the emotion out of the decision-making.
Steph, I want to go back to some of those percentages. So when you say 5%, if your stock allocation is 70%, what you're saying is if it gets above 75 or below 65, then maybe you want to revisit it and get it back to that 70% level. Is that right?
Exactly. Setting those kind of reminders or those triggers, that acceptable range, and just using that for when it's time to rebalance. But it can be different for everyone. It just kind of depends on how you're feeling about the market and what you're most comfortable with. But you need to set it because that's the only way you can remain disciplined.
Exactly. Let's talk a little bit about the fact that, of course, you work with clients every day. What are some of the common misconceptions you're seeing from clients about what's entailed with sort of the ongoing portfolio management? In what ways might they be over or underestimating the involvement needed to kind of stay track on their goals?
So a lot of people think they need to beat the market to be successful. And yeah, it sure helps, but success is measured by the progress toward your goals. Are we on track? And this is why the plan is so important. We have to identify, prioritize, and quantify your goals. Then stress test the portfolio against different scenarios to determine that minimum rate of return needed to be successful. And the thing is, typically that minimum rate of return might be less than you think. Or some may think once they've put the portfolio in place, they can set it and forget it. But your portfolio should be reviewed, adjusted as life changes. The portfolio should evolve with you. And others may overmanage and constantly tweak the portfolio, thinking they always need to do something when the market fluctuates. Reviewing the portfolio when markets change is one thing. Daily tinkering is another and can lead to emotional decision making. Did I do this right? Oh, I didn't mean to do that. I need to, offset that with a different trade. And another misconception is risk. Most think it's just about losing money, but that's unfortunately part of investing. Our expectation is to make money when we invest. So when we see our portfolio drop, that pain has a stronger feeling than when the portfolio goes up. Again, we're expecting it to go up over time. So it's important to accept the fact that there will be gains and losses over time. Risk reflects uncertainty and the variability of returns, but we have to accept it.
So essentially, every time there's a market swing or there's a news event, that's typically going to affect client behavior, at least are going to cause clients to start thinking about their portfolio. And we're all human. We all do that. So what steps do you take to help ensure that they're staying on track with their long-term financial plan?
Well, when markets go up, clients are typically happy. When they go down abruptly, clients are less happy, as are advisors. Some may not pay as much attention when the market is doing well. The regular check-ins are more about travel and other fun things, less about the market. And again, it's because there's a stronger emotional response to the downside than the upside. And unfortunately, in our day and age, that downside response can be amplified by a barrage of negative news and headlines. We're just inundated with information. And when the market is acting crazy, it's just all negative. And it all starts to pile up, and it's all you hear. So it can be difficult to filter out the noise and figure out what's really going on, what really matters. And so this can lead to impulsive portfolio decisions, those emotional decisions. Again, rebalancing can keep emotions in check. Without rebalancing, your portfolio becomes riskier than you think. And when the market conditions change, sometimes with little warning, you may see larger losses than what you're expecting. And that can lead to emotions taking over and panic selling. And when you start panic selling, it can be hard to get back in. You have to overcome that emotion and fear of losing again. And so a lot of times people end up delaying when they're going to get back in. And we got to remember that some of the worst days in the market are followed by the best days of the market. And if you're not invested during, the top 10 days over the last couple decades, you're underperforming.
Steph, I think you and I are aligned in that we think about portfolios as kind of an integrated unit, but we know that investors sometimes will have a lot of tunnel vision on individual positions or asset classes. So why is that? Why do they do that? And what helps them maintain a broader perspective on on the overall financial goals that the portfolio is trying to help achieve?
When that happens, and it happens a lot, we're human, it's going to happen. It's like we can't see the forest through the trees. They can't see the portfolio and how each position has a purpose and how positions complement each other. And so they're focusing on that one leaf of one tree of a huge forest. The leaf is fine. Let's look at everything else and how they work together. And a lot of times seeing red on the screen, a loss, can trigger a strong response and lead to only wanting to talk about that position. It gets obsessive because it's the only one in red, or it's only a few positions that are red. But we have to remember there are times where a particular asset class or sector might be out of favor or underperform. But that doesn't mean it's a bad investment. That's the point of diversification, owning different asset classes that don't move lockstep with one another. We want investments that don't have the exact same sensitivity to inflation, to interest rates, to consumer spending, or tariffs. So reviewing each position, understanding why it's in the portfolio, what it's meant to do, how it complements other positions can help overcome this tendency. It doesn't mean ignoring a position with a loss, but rather dig into whether the loss is expected for a particular asset class in light of market conditions. You need context.
Steph, since we're talking about individual holdings, that reminds me of the fact that, many investors are actually holding on to pretty concentrated positions, even when it might not be in their best interest to be that undiversified. So how do you talk to them about deciding when it's time to let go and in fact, diversify from a concentrated position?
So a big reason investors hang on to their concentrated positions, well, is because they've been showing a gain for so long. It might be a company they worked for, or a stock they inherited from a family member, or a really awesome stock pick. And this can lead to an irrational emotional attachment. And we've talked about this before. It's okay to date stocks, but we shouldn't marry them. So in this situation, investors might not be reviewing how it compares to peers, or they don't even see it as a risk. It's always shown green on the screen. It's familiar. It's comfortable. Sometimes owners of concentrated positions ignore negative information about that stock, and when they do research, they only seek information that confirms they should hold it. So they're not considering opposing viewpoints. Another reason investors may be hesitant to reduce a concentrated position is the tax consequences. You got to pay the piper at some point, but you can do so strategically. You can determine a capital gain budget for a given year, as well as exit prices that you're willing to accept while incorporating tax loss harvesting strategy. And I do recommend you do that in January versus December. It's a lot easier to plan the whole year versus a fire drill on December 15th. But also, if you're giving to friends, family, or charity, this is a great way to do that. Just use the concentrated position. Your cost basis does carry over to the person you give it to, but if it's a charity, it doesn't really matter. And there are also more sophisticated strategies available, and you can talk to your financial consultant about them. Now, when a position is at least 10% of your portfolio, that's a good reminder or good rule of thumb to reassess and consider trimming it. But if you're still working for the company, that kind of rule of thumb could be 20%, as you might not be able to sell it due to company policies and company restrictions. It's important to remember a large position will dominate the portfolio's performance. Of course, we all hope that means higher returns, but it may not. Could some of the money be better served elsewhere, a different stock, sector, or asset class? Because there's an opportunity cost of having most of your eggs in one basket. If you're transitioning to retirement, does the stock pay a dividend? Could there be a more tax efficient and reliable way to generate income? And this doesn't mean eliminate the position as long as the outlook remains healthy, but rather consider other investments that can round out your portfolio. Again, balance matters. Because when you're balanced, it's a heck of a lot less stressful when the market gets volatile, and it's less work.
Steph, another thing that pops up when people are looking at individual positions is they sometimes have a reluctance to sell one at a loss. How should they decide when it's time to let go of something that, frankly, hasn't treated them especially well and is a likely dud?
Well, as humans, we tend to experience regret aversion. We avoid action based on regrets from previous mistakes or so-called failures. So we end up holding losing positions too long. And again, it's important that we accept the fact that losses are part of investing. By not selling in this kind of situation, we avoid the uncomfortable feeling that we messed up. Reviewing the position's current and future outlook can help you make a decision on whether to let it go or hang on. Is this something you would buy right now? What's changed? Has the competitive landscape or the product mix changed? We've been hearing about a lot of tech companies pivoting into AI. Will they be successful? And if the outlook appears rocky, it may be time to let it go and replace it with something else. There are other stocks out there. And if the dud isn't a taxable account, time to use those lemons and make lemonade. If it has a loss, we can harvest it and use it against gains to reduce your tax bill.
Steph, we've been talking about things that affect the portfolio, like the overall market, or just looking at our own portfolio and how the individual components are doing. But how would you say comparing your portfolio to others and how they're doing, how does that impact their decisions?
So it's easy for us to feel FOMO, or the fear of missing out. We hear about a new trend, a new opportunity, and we don't want to be left behind. We want to get on it, right? And that's been a real thing over the last few years because we've seen these ridiculous returns from a handful of stocks. But just because your friend made money on some speculative stock doesn't mean it's appropriate for you. A client might tell me about a coworker or friend and how much money this coworker or friend has made. But a lot of times this person is in a completely different life stage and financial situation than my client. So I don't think my 67-year-old client who relies on his portfolio for most of his living expenses should worry about keeping up with the 22-year-old speculative stock portfolio. The 22-year-old has time to make it up if it doesn't work out. They're not living off the portfolio yet. We've all heard it. People love to brag about how crazy their returns have been at a given time, typically in a bull market. But it gets pretty quiet when the market turns against them. And it's easy to get caught up with the herd and chase an opportunity without doing your own research. This can lead to a crowded trade, and that drives up prices in the short term because everybody's getting in on it. But that can also lead to larger losses when the trend reverses. Reversion to the mean is something everyone should remember, as well as the trend is your friend, but you still have to look out for those pivot points. So when I see this happen, I go over the analysis, the pros and cons of a particular idea, how it may or may not fit in the portfolio given a client's specific circumstances. Because it really is about, is this appropriate for you versus someone else? Because you don't always know what's going on with that other person.
Yeah, FOMO is a tough opponent to beat. There's always some kind of investment that's doing well, but that doesn't mean all of those investments make sense for you. Investing is about balancing both risk and return, and that's a very personal decision. The same applies when comparing your investment approach to that of others.
Exactly. This also reminds me of the phrase, keeping up with the Joneses. When clients unnecessarily compare their situation to a perceived better off or more successful friend, neighbor, or relative. When this happens, I emphasize the results of their plan. We review their plan in detail, go over the larger purchases and other things that we've incorporated. Maybe it's travel, maybe it's gifting, maybe it's a second home, maybe it's starting a new business. But it also might mean the client needs to do more research on the things they want to buy that isn't in the plan. They might want to increase their spending, but just aren't sure if it's possible. And again, I just need them to go back and review what are the other things you want to do. And then we can come up with figures for that and rerun the plan with the new assumptions. Stress test against good, bad, and flat years. I also might incorporate different investment strategies to illustrate how higher risk can impact the results. And it's interesting how, yes, we can run a scenario with a higher rate of return, but that could actually negatively impact your overall success rate because we're also increasing that risk. We're also increasing that standard deviation, which means a lot more variability of outcomes versus the lower risk portfolio. We kind of have a narrower set of results because there's a bit more reliability as to where we expect the portfolio to end, so to speak. Now, if the client is very close to retirement, it might not make sense to take on more risk. And again, this really depends on the client's situation and their risk tolerance.
Steph, earlier you mentioned tax loss harvesting. So tell me a little bit, maybe take a step back and tell me a little bit more about the role of tax efficiency and what role does that play in investing?
Well, Mark, as we've heard this saying for a number of years, don't let the tax tail wag the investment dog. But taxes do matter, especially if you're in a high tax state. It just shouldn't dominate your investment decisions. I mean, we want to make money, right? And tax efficiency means maximizing after-tax returns through tax mitigation strategies. It doesn't mean we avoid realizing capital gains when it makes sense to take them. It means considering the tax implications based on asset selection, like index fund versus actively managed fund or muni bond versus taxable bond, asset location, which investments should go in the taxable account versus the IRA, and timing. Paying attention to your holding period. Again, the tax rate on short-term cap gains is higher than the tax rate on long-term cap gains. And long-term cap gains or the holding period, you need to hold it for 1 full year and a day for a position to be considered long-term. Incorporating tax loss harvesting can help. So selling an investment at a loss and buying a similar but not substantially identical investment means you capture the tax benefit while staying invested with the hope of making up those losses over time. So, for example, selling an individual stock, but buying a sector ETF that holds that stock is an example of this. We're still participating, we're still staying invested. And then the loss on the stock can be used to offset gains elsewhere in the taxable portfolio. But be careful not to re-enter that same or substantially identical stock for 30 days after your sale, as well as 30 days before, or you'll trigger a wash sale and that loss will be disallowed per the IRS.
Steph, there are a lot of costs when it comes to investing. Do you get the sense, though, that investors are more averse to taxes as a cost than, say, expense ratios and that sort of thing?
Well, it's basically taxes and the cost of investing are both drags on the portfolio over time. So we're all kind of averse to both, right? We want everything to be free and we don't want to pay tax. So that's why indexing has become so popular, because it's low cost, it's transparent, and it's tax efficient versus those actively managed equity mutual funds. So ultimately, the investor has to see the value of these costs. You can buy a bunch of stocks and monitor it and kind of create your own basket, but that's a lot of research. Do you have the time? Versus using an ETF or another fund, or even, going into a different kind of advisory relationship. And really, how much time and energy do you want to spend on your portfolio and your plan? Would you rather outsource that work? Because it is work, I can tell you. So working with an advisor can be less stressful and give you your time back. We're always pulled in a lot of different directions at any given time, friends, family, work, market, the news, that it can be difficult to be fully dedicated or fully present to the management of your financial situation.
Steph, as you've mentioned, the portfolio serves the needs of the plan. But as you mentioned in the first episode of this two-part episode, at some point the plan needs to change. So how do investors determine when the plan needs to change, and then, of course, enough that that's going to trigger then portfolio changes?
A good rule of thumb is updating your plan every couple of years. So I always tell my clients rate of return assumptions, inflation assumptions, expenses. They can change over time. So regular updates really do keep the plan relevant and take into consideration those other mathematical assumptions. But another rule, and probably a more important rule, is to update your plan when there's a major change in your life. And with that major change, it might, again, change your expenses, savings rate, or the timing of goals like retirement. And this could mean, the death of a spouse or illness in the family. It could mean the loss of a job or an unexpected windfall like an inheritance. Now, positive changes too can trigger a plan update, like marriage or moving to a new state with a different tax rate for your dream job. Revisions to the plan may not be necessary, but at the very least, review it every couple of years.
And then how do you, so you've done that review, you've decided to make some changes to your plan. How do you decide whether those changes are sufficient then to change how you allocate or are managing your portfolio?
So we're updating the plan, and we'll be able to forecast the values. We'll be able to look at the timing of the different cash flows. And really, if the change is big enough, it could mean reassessing the risk of the portfolio. And it really depends on the type of change. Are we expecting money coming in or going out? If money is going out, reviewing your mentally separated sub-accounts and where you may need to pull from is the first step. It might mean reallocating one of those sub-accounts to ensure you have enough liquidity. So I'd say, again, the addressing the liquidity, the cash crunch is the first step. Once you have that figured out, you can review whether the long-term sub-accounts like IRAs need to be adjusted.
All right, final question for you, Steph. What are some of the key points that you want listeners to take away from this episode?
Well, one of the takeaways is that risk part of investing. Whether we like it or not, we have to accept some level of risk to help us meet our goals. We expect positive returns over time, but losses will happen. And I think it's important to note a lot of our conversation today talked about time in the market, not necessarily timing the market. Wealth building doesn't happen overnight for most people, but over a lifetime. Another takeaway is that you did all the work to put together your financial plan, creating a portfolio to bring your plan to life, and now we just have to stick with it. But that tends to be the hardest part. When we see significant downside volatility and only negative news, it can be difficult to remain disciplined and not overreact. In a rapidly rising market, it can be tempting to chase returns, but it's important to review whether a new opportunity makes sense given your objectives, cash needs, and situation. Ongoing monitoring can help determine when it's time to rebalance. And rebalancing can keep emotions as well as risk in check by keeping each asset class within an acceptable range based on your overall investment strategy and risk tolerance. Be sure to reach out to your financial consultant if you have any questions or would like help navigating these ideas, because that's why we're here. We're here to help.
Steph Shadel is a director and senior wealth advisor at Schwab Wealth Advisory. Steph, thanks for being here today.
Thanks so much, Mark.
Steph covered some interesting ground and gave us some great ideas around turning your plan into your portfolio. Also, your financial life is about more than just your portfolio. There's lots that isn't about your investments. You've got to pay attention to those aspects as well. Estate planning, for example, tax planning, insurance, charitable giving, and that's just the tip of the iceberg. Speaking of charitable giving, be sure to listen to our next episode in 2 weeks. It's the time of year when charitable giving is on many investors' minds. I'll be talking about it in depth with Schwab's resident expert, Julie Sun Wu. If you'd like more information on planning and portfolios, check out schwab.com/financial-planning. We'll have that link in the show notes. With Thanksgiving just a few days away, I'd also like to thank those of you who have already provided a rating or review on Apple Podcasts or a comment on Spotify. I'm also thankful for those of you who told your friends and family about the show. If you'd like to hear more from me, you can follow me at my LinkedIn page or at X at Mark Riepe. That's MarkRiepe. Thanks for listening. For important disclosures, see the show notes and schwab.com/financial decoder.